Hi, very good morning to all, and my apologies for the late start due to some technical error. So yesterday we do see a broad-based risk-on rally in the global stock market yesterday, and the benchmark US stock indices, three of them, the Russell 2000, the S&P 500, and as well as the Nasdaq 100 scale fresh all-time high due to renewed optimism of a near-term US-Iran peace deal resolution that may take place this week. The Dow Jones Industrial Average is not far back as it managed to test the 50K psychological level despite it being a laggard in the past 2 weeks. And the US dollar has started to remain soft, supported by potential intervention coming up from the Japanese authorities, where the dollar yen plunges by a significant amount in yesterday's Asia session. Gold managed to rally back up to the 4,700 per US dollar per ounce, but however now faces a intraday resistance at the 50-day moving average. West Texas crude oil plummeted down towards the 50-day moving average, and in today's Asia session, it managed to find a intraday support around at this level. Welcome back to today's daily dose of market insights, and today going to be another volatile session given the changing headlines that we are seeing in the global market space. I'm Kelvin here. Today will be the Thursday, the 7th of May, 2026. So as usual, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right. So as usual, let's have a quick recap what has taken shape in the last 24 hours. And in today's daily dose, I will not cover the full suite of all the intraday technical outlook on those broad-based cross-asset classes that we tend to kickstart on Monday. Instead, I will select a few of them that is showing very interesting technical configuration, be it them breaking above or breaking below key intraday technical levels. So before we jump straight into that, let's have a recap what has taken shape in the last 24 hours. So for sure, let me share my screen first over here. All right, good. So the key headlines will be pertaining up from this ongoing US-Iran slash war conflict that has been in play for the 9/10 week. So yesterday there was this particular head news saying that some form of positive diplomacy has taken shape, where Iran now is considering a new proposal put out by the US through the mediator Pakistan, saying that there could be a potential peace deal agreement that may take shape this weekend over here. So one thing in mind over here is that we know that China has also a potential influence in the relationship with Iran. And right now, Iran foreign minister is yesterday has a meeting with the Chinese counterpart over here, and saying that the Chinese counterpart urged the Iran side to actually put away that urge the Iran side to formulate a longer term kind of a peace deal arrangement with the US. So apparently, with this kind of remark out from the Chinese counterpart, given that the China has a potential influence towards Iran affairs, with China urging Iran side to actually formulate a longer term peace deal arrangement with US, meaning that the Chinese side is kind of losing patience with Iranians' hardball tactics. So that actually give a bit of indirect, implicit, we call it push for the Iranian side to come into a middle ground, as in the last 2 weeks they are trying to play a game of poker with the US. So that actually increased the probability of an imminent peace deal resolution between Iran and US to solve this ongoing conflict. And with that in mind, that could potentially allow the Strait of Hormuz to slowly regain its normal operation, in turn reducing the global energy slash oil supply crunch that we see in the last 2 months or so over here. All right. So with that, we could we see a spillover positive feedback loop into the US stock market, where all four of them close in the green, continue to be led by the Nasdaq 100, up by 2%. So if you look at the heat map of the S&P 500 over here, so the S&P 500 almost see a slew of deep green across the board. Okay, give me a minute. Across the board, with the acceptance of defensive play, utilities in the red, and for sure energy stocks also slid, as well as hedges got unwind over here. So if you look at the heat map, excuse me, on the grouping on a sectorial basis, we see very deeply in the green for all the 10 sectors, but two defensive sectors are deeply in the red, with the utilities down by negative 0.9%, 0.95%, and energy stocks hedges, initial long hedges got unwind, where the energy sector plummeted by close to negative 4% yesterday. And what is interesting over here is that if you look at the CME Fed Watch 2. All right. So you look at the CME Fed Watch 2. So this CME Fed Watch 2 allow us to decipher the market expectation on future monetary policy decision making process by the Fed. So this is based on the latest price action trading behavior of Fed funds futures traders. So despite the ongoing so-called potential imminent peace deal resolution agreement between US and Iran that may take place this week, the Fed funds futures traders still does not believe or does not have a view that the Fed will do a interest rate cut this year, right? Because potentially, yes, we may see the peace deal coming into play, but to allow the Strait of Hormuz to resume its normal operation, it may take some time because infrastructure got damaged along the way, and that could see oil prices remain stuck at this range of between what, 80 to $90 per barrel. All right. So if you look at the probability across the different calendar or the different FOMC meetings in the next few months. So the current Fed funds rate is at 3.5% to 3.75%. So we still see very high chance that the Fed will still maintain stamp at throughout this year until the last meeting of this year, December the 9th. 92% chance, a high chance that the Fed will remain stamp at 3.5% to 3.75%. And the Fed may only introduce a interest rate cut only in the Q3 of next year, or the second half of next year, where we see a 24% chance that the Fed may introduce a 25 basis point cut on the October the 27, 2027 meeting. All right, over here, that's next year, October, to bring the Fed funds rate down by 3.25% to 3.5%. So overall, what the market participants in the Fed funds futures market view right now in terms of future monetary policy decision making process by the FOMC members or the Fed, put it away, that the Fed will not immediately turn dovish, all right, for this year. All right, so potentially there could be still some constraint in terms of liquidity. Okay, but nevertheless, in the short term, we start to see the dollar weakening over here. So if you look at the US dollar uh, FX market, we see initial significant plunge yesterday. All right, so this plunge over here is done by the dollar yen because of that suspected intervention. Later, I'll show you the dollar yen intraday chart. So then thereafter, the dollar starts to recover slightly. All right, so if you look at the 1 day rolling performance, all right, the dollar now is doing a bit of bounce as we are speaking right now. So why the dollar is bouncing? Because number one, like I explained earlier on, the current Fed funds futures traders price action behavior hasn't really starts to price in a significant increase of probability that the Fed will introduce one interest rate cut this year. So they continues to maintain their view that the Fed will remain on hold for the entire year of 2026 and only introduce the next 25 basis point cut in the later part of next year, not the first half of next year, but in the later part, which comes in October. And if you look at the technical configuration of the US dollar index over here, so the US dollar index is now testing this support level. All right, so this support level is at 97.95 over here, where it managed to find support since 14th of April. Then thereafter, it traded in the sideways range. So potentially this support level may introduce some form of minor dollar strength coming into play. So but overall it's still trapped between 99.16 and 97.95 over here. So unless we start to see a daily close below 97.95, then potentially we may start to see a resurgence of dollar sell-off or dollar weakness heading into the near term as it float back down towards the lower limit of this 1 year plus of major sideways complex range configuration that has been in place since late May last year. All right, so that's for the dollar story right now. And also, given the fact that why the Fed funds futures trader is not having a high probability of pricing of a 25 basis point cut to come in this year, because of a kind of a not really that soft US labor market. So yesterday we do have one particular, not really tier one, I would say that more like a semi-tier one US job market data. They call it the ADP employment change. So ADP employment change is something like a privately organization compile labor market data for US. So you know that the US non-farm payroll data will be due this Friday. So that is coming out from the official government agency. ADP is a private organization. They do also compile their monthly employment change data to have a gauge of the US labor market, but very slightly they tend to use a bit of different statistics. That market tends to pay more attention to the one that is being compiled by the US government agency, which is the non-farm payroll data. So the ADP employment change data for April actually show a rather resilient US labor market. 109 job K 109K jobs added for the month of April, up from 61K added in March, and also above what market consensus of 99K. So this represents data that the labor market hasn't drastically turned soft yet in the US economy. And that actually also further supports why the Fed funds futures trader is not pricing in a high chance that the Fed will cut this year at this moment in time. All right. So that pretty much sum up the first segment of the daily dose. Now let me move on to the second segment, which I will cover various key interesting technical configuration that is forming right now on the broad-based cross asset classes. So let me start with the FX market first over here, starting with the dollar yen. All right. So if you look at the dollar yen, right, so this is what we shared on the dollar yen yesterday. So yesterday we have a bearish bias. All right, so the price action indeed broke below our lower limit of this bearish ascending wedge configuration, which I highlighted yesterday. All right, now turns into a pullback resistance at 15730 slash 15755, and we see this tremendous 15-minute slash 30-minute sell off at the 12 p.m. mark yesterday Asia session. So this long black candle, bearish candle, highly smells of a potential Japanese authority intervention, even though there's no news report officially stating them that they kind of admit to it. But the price action so swiftly, if you look at the 15-minute, very obvious. There's a 2 15-minute of sell off, 12:15 p.m. Singapore time yesterday, and 12:30 p.m. Singapore time yesterday. So usually these two black candle or sell off without any clear fundamental or macro event that has taken shape smells of a potential intervention, despite there is no news flow stating that there is. All right, but nevertheless, it has started to skew the technical picture towards a reinforcement of this minor downtrend phase that has taken shape since the high of 30th of April. So with that, we will continue to maintain a intraday near-term bearish bias on the dollar yen using a adjusted downward pivotal resistance zone for today. So 157.30, 157.55 will be my pivotal adjusted resistance zone short term for today. Maintain that bearish bias. Breaking below 155.55, where yesterday it managed to survive, will potentially see a renewed potential downside pressure towards the congestion area of 19/24 February this year. Also a Fibo extension level on the downside, 0.618, 156.65, followed by 154.05, which is the 23rd of February 2026 low that confluence with two other different technical elements the 0.764 Fibo extension on the downside, taking into account of the ongoing minor downtrend phase since 30th of April, and also now confluencing with the key 200-day moving average. Only a sudden rebound and a bullish breakout and an hourly close above 157.55 that would invalidate today's bearish buyer's view to see a squeeze up towards 158.10, maximum 158.60, which confluence with the intersection between the 20-day and the 50-day moving average. So that's for the dollar yen. Next instrument to watch out for will be the major US stock indices over here. So let me kickstart with the US Wall Street 30. So the US Wall Street 30 finally now shows signs of a resurgence after lagging behind their peers in the last 2 weeks or so. So very clearly it staged a bullish reversal right above the 20-day moving average after testing it on Monday, and also testing a ascending channel support level drawn from the low of 30th of March over here. So with that, I will now have a adjusted slightly upward short-term pivotal support level, 49,430, just to make sure that everything is good here. All right, I think it should be good. All right, so let me repeat. 49,430 will be my short-term pivotal support today, adjusted slightly upwards, and that level also confluence with the low that is being seen yesterday during the start of the early London session, and right now also the lower boundary of this ascending channel drawn from the low of 30th of March. Breaking above 49,990, which is trying to do an attempt right now as we are speaking at 11:25 a.m. Singapore time, may see a retest on the current all-time high at 50,541 that was printed on the 10th of February this year, and above it potentially take us up to the next resistance zone and intermediate resistance zone, which is defined by a Fibo extension level of 0.236 and 0.382 taken from the latest bullish impulsive upmove sequence since the low of 30th of April. That will be at the zone of 50,835, 51,058. All right. However, if we start to see a sudden bearish breakdown below 49,430, that would negate the bullish tone to see a retest on the 20-day moving average at 49,070. Only an hourly close below 49,070 will unleash a minor corrective decline sequence towards 48,500 / 48,327, which is the minor swing low of 30th of April and 16th of April. Okay, so that's for the US Wall Street 30, a laggard now showing a signs of bullish momentum resurfacing. Next will be the SPX 500. So the SPX 500 was one of the leading stock in the US benchmark stock indices. So it rarely hit our resistance level, and right now I'll be rather cautious of this move. There could be a minor pullback taking shape. Why? Because the hourly RSI has started to flash out a bearish divergence. All right, lower high where we see a higher high in the short-term chart on the SPX 500 as expressed by the hourly chart. So with that, I will flip to a neutrality stance instead on the S&P 500 for today. So neutral between 7,395 and 7,270 given this bearish divergence that is being seen. However, if it starts to do a continuation of this bullish acceleration with an hourly close above 7,395, then this very steep bullish impulsive upmove sequence from the low of 5th of May may continue higher towards the next resistance level at 7,472, 7,505, which is a bunch of Fibo extension cluster level. Lastly will be the red hot Nasdaq 100. So the Nasdaq 100, very steep recent bullish impulsive upmove sequence from the low of 5th of May also hit our resistance level 28,510. Now it's fast approaching the next resistance level, which we highlighted yesterday, 28,860, 28,890. So with this level coming into play, and also the very clear bearish divergence that has been flashed out to lower high on the hourly RSI at the overbought level, I'll be also very cautious of chasing this move. So for today, I will, given that the resistance level has already been met, which we expressed, which we highlighted yesterday, and with this bearish divergence into play, there could be a pullback taking shape in today's US session. So with that, I will now be very cautious on the Nasdaq 100 in chasing this intraday push up. So instead, from the intraday basis, I will wait and see now. and have a neutrality stance instead. So neutral between 28,860, 28,890. Lower limit will be yesterday's bullish hammer candlestick low that is being formed at the start of the US session, 28,200. So if we start to see a breakdown below 28,200, then potentially we may kickstart a minor corrective pullback towards 27,850, 27,540 in the first step. So turning neutral first on the Nasdaq 100 due to this very steep bullish impulsive upmove sequence that has been accompanied by a latest current bearish divergence that's being seen on the hourly RSI. So that's for the Nasdaq 100. Next up will be the commodities market over here. Let me very quickly take you through. Starting with the Gold XAU/USD. So Gold XAU/USD squeeze up, breaking above 4,645, and is now coming very close to the 4,775 level, which is the 50-day moving average. And what we could see right now is also a bearish divergence that has already been formed as well on the gold price. All right. So with this bearish divergence on this gold price over here, I also be very cautious of chasing this swift move up now over here. So perhaps there could be some form of consolidation taking shape in today's intraday session. All right, so I will flip to a neutrality stance right now. So neutral between 4,775 and 4,645. So if we start to see a breakdown below 4,645, then potentially intraday weakness could come to set in back into Gold XAU/USD again, retesting 4,580, breaking below 4,580. May see the range support coming in that has been in place since 29th of April at 45.24, 44.86. So that's for Gold XAU/USD, turning into a neutrality stance today due to that bearish divergence that's being formed on the hourly RSI, watching 4,775 on the upside, on the downside 4,645. Lastly will be the West Texas crude oil. So the West Texas crude oil, notice that it plunges down and hit exactly at 90.50 before staging that intraday bullish reversal at Wednesday, what this is, what 7 p.m. Singapore time. Then thereafter, in the entire US session, it traded sideways despite the US stock market going up higher and higher. So there's some form of support coming in at the 90.50 level. So with that, I will turn neutral for now for today first over here. So neutral between 90.50. Okay, give me a minute. And yesterday's pivotal support level broken down will now turn into the upper limit of this neutrality zone that we have for today. Right, so let me adjust everything. 120. Okay, let me. Okay, this is the gap support. And this is the low of 17th of April. Okay, so if we will do the Fibo retracement of this previous up move from 17th of April all the way up to the high of 30th of April, now we are resting very closely at the 76.4 Fibo retracement, which is also very close to the 90.50 where it managed to stage a bounce yesterday at 7 p.m. Singapore time. Then thereafter, it traded sideways in the entire US session. So with that, I will flip to a neutrality stance, given that there's some support being formed at 90.50. On the upside, yesterday's broken down key short-term support level will be turns into a key resistance today. So this will be my neutrality upper limit. So flipping to a neutrality stance for West Texas crude oil, neutral between 120 and 90.50 over here. So only breaking above 120, then potentially we may see a intraday push up to retest this week current high at 108.20. However, if we start to see a breakdown below 90.50, then further weakness may materialize towards 86.57, then thereafter followed by 82.98, which is the swing low of 17th of April. All right, so that sum up the second segment of the daily dose, which I highlighted the key asset classes to watch, given the fact that they are now testing or breaking key technical levels and or showing very interesting technical configuration. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So let me make sure that this, okay, let me change to make it into coverage of more data for you to highlight. Okay, so today will be Thursday, 7th of May over here. So as we head into the European session, okay, give me a minute. I think it's hang my screen. Okay, 1 second. Give me a minute. I think my screen is hang again. Okay, I think. Okay, I'm not sure why my internet connection is very bad today. So that causes the earlier technical so-called hiccups. All right. So yeah, it's good. It's okay again. So for today's start of the European session, we have ECB official De Gunder speaking at 3:15 p.m. Singapore time. So that could influence the euro crosses. And with that, at 5 p.m. Singapore time, we will have Eurozone retail sales over here. So for the year on year for the month of March, market is expecting a decline to 1% from 1.7% that was printed in the previous month of February. So that could also influence the euro crosses, the euro dollar, and as well as the German 30 or the German DAX over here. So that's 5 p.m. Singapore time. And at 8 p.m., we have another ECB Edison speaking. And at 8:30 p.m., we have Tier 2 US labor market data. So this is much more volatile as the weekly initial jobless claim and the weekly continuous jobless claim. And 8:40 p.m., we have another ECB official, ECB Lane speaking over here. And that's pretty much sum up for today's key we call it data to chew on, and as well as the all important news flow will be this situation that is happening between US and Iran, as market participants continues to look out for more news flow of that potential cementation of the upcoming US Iran so-called peace deal resolution that is now gaining higher probability. All right, so this particular news flow will potentially sway the market. So as usual, do practice proper risk management on an intraday basis. So with that, I'm Kelvin here signing off, and we shall speak again tomorrow. Thank you.